Hey folks, we're glad you could join us on yet another conversation on Business Redefined, your weekly most comprehensive look at the world of business, finance and economics. We are getting into the last leg of the budget cycle, that is preparing for the budget for FY 26-27, which starts on July 1st this year. Now, this cycle has started a little earlier, thanks to the fact that we have seen the VAT Amendment Act of 2026, and we now have the Income Tax Amendment Bill of 2026 as well, which has gone through the Committee of the Whole House. And we're privileged to be joined by Robert Waruiru. Not a surprise here, a man who's quite a regular in these conversations. Robert, karibu sana.
Thank you very much.
Glad to have you on set.
Thank you.
Let's start with the two documents which I wouldn't say surprised us. Of course, because of the heat that we had around the pump prices, the VAT amendment had to come. But what we did not anticipate was the Income Tax Amendment Bill. Because we had been told we would see it before Finance Bill. Then we were told that they were too close, there was no point, let's just have Finance Bill. Let's start with the income tax. CGT, what do you make of it?
Well, I agree with you. First of all, we had been told that there's going to be legislative fatigue. Yeah. And that's the reason why it's a surprise. It was a surprise to many of us. And so the fact that it came in with one provision, which is a CGT exemption, that was a surprise. But perhaps even more surprising was that we didn't have the VAT. So again, something perhaps to look forward to in the Finance Bill 2026. But tell me,
I think you meant POE, right?
POE, yes. POE, sorry, POE, yes. The POE amendments that the President and the CS had been talking about. Now, talking about the Income Tax Bill Amendment 2026, the idea here is that you want to exempt from capital gains tax reorganizations, corporate reorganizations especially. The bill was focusing on corporate reorganizations where there's a transfer of shares. Now, under the current regime, that kind of a transfer would, one, be subject to corporate capital gains tax, and two, would potentially give rise to a dividend, because if you're a shareholder who is getting these shares in a reorganization, you'd potentially be deemed to be accruing a dividend and therefore subject to dividend withholding tax. So that's what it was trying to cure. Now, of course, there's been a lot of public participation around that. We are waiting to see what the final product is going to be out of Parliament. But it's an interesting one because as a country, we are exempting CGT, yet we are struggling from a revenue perspective.
But Bob, look at it this way, and many have argued. One is that there is need for a threshold here. If you look at the submission that was made by one of the donor-led organizations, it was, let's adopt 50 million. The control of budget had something around 500 billion in terms of the value of assets being involved in the reorganization. Do you feel there's a genuine case for a threshold consideration in this bill?
I actually think there is, and when you think about revenue neutrality, because I think that was one of the biggest issues, we are foregoing this tax. So how do we, what structures do we put in place to ensure that the foregone revenue is somehow recouped? And that's the essence of the threshold that people are talking about. And so, for example, some people say, if the transaction is 50 million and below, then fine, it can be exempted.
Yes,
and
but above standard rate.
Yes, standard rate. And in fact, actually, some are arguing that it should actually be higher, not just the 15%, perhaps 20%. We're waiting to see that. We're going to exempt the CGT on these transactions, the smaller transactions, which will probably be for, let's say, a majority of the transactions. However, for bigger transactions where people are able to pay, then why exempt? You know, that's the thinking. So I think the revenue neutrality issue is an important one, and I think there's a second bit of it, which is visibility.
Yes.
So if you have a threshold, you'll probably require people people who are involved in these transactions to make a disclosure, and then that way, revenue authority is able to see to assess whether it qualifies for the exemption, for example, and then you're able to safeguard revenue. So I think the threshold issue plays that twin role of safeguarding revenue as well as visibility.
What do you think about those who have argued that, one, this threshold needs a periodic revision? I remember seeing a proposal, let's revise it every 3 years in line with inflation. And secondly, those who have argued that there needs to be a sunset date to this provision.
Well, first of all, Julian, if you look at the national tax policy, there's actually a clause around sunset provisions for this
for preferential rates.
Exactly.
Yes. Yeah.
And so there's a need, I think, and I agree with that. There's a need for having these sunset clauses. Otherwise, then it becomes a challenge to assess the impact of this. Now, the issue of 3 years, I think, in my view, makes a lot of sense. Why? Because we've had a challenge in this country where we pass a lot this year, then barely 12 months later, we reverse it. So when you talk about a 3-year revision clause, I think it's good because we want to see the impact of this. Is it achieving the intended purpose? And if it's not, then we can have review perhaps the framework of that. So in my view, there is sense in having those two provisions. We don't know whether it's going to come through, and probably this is going to be the first, in a series of sunset clauses that we are going to see going forward.
Robert, I have read the income tax amendment bill as brief as it is a number of times, and I've tried to make sense of this bill. One, from a timing perspective. Two, from the fact that if you read the MTRS, the medium-term revenue strategy, there is an argument that there is need to harmonize CGT with the corporate income tax rate. Are we setting the stage for a potential play of what we consider wealth tax, possibly by a Finance Bill 26?
It's actually likely. In fact, if you look at some of the submissions that came in, to ensure revenue neutrality, there's some proposals that are saying anybody who holds assets above a certain threshold, yes, then is going to pay that tax. And if you ask me, really, Julians, do we have a lot of headroom in all the other taxes? I don't think we have a lot of headroom. And so, to your point, are we setting the stage for a wealth tax? It's quite likely, yeah. And especially given that we are going into an election next year. So we don't really expect the administration to come up with very radical proposals. If you look at Finance Act 2023, massive changes, and many of them actually. Yeah? Yes, I think that act had about 104 sections. So massive. I don't think we'll have that this year, but certainly it's probably time that Kenya started looking at some of these novel tax provisions.
VAT. Amendment Act. Now it's an act because it was signed into law. In the month of April, we effectively had 3 rates of VAT for petroleum products. We began at 16%. Then we moved to 13%, I think for 2 days or so. Then we moved to 8%. When it comes to administration and filing, have we seen any guidance from the authority around how that will play out? Because if you remember, I think it was in 2020, we had absolute chaos when it came to filing under these multiple rates.
Indeed, and actually, if you remember as well, 2023 filing was also quite tough for individuals, because that's when we also had a change in the tax rates for individuals up to 35%.
Yes.
So whenever there's a transition, especially midstream, you can expect that there's going to be chaos. Because, for example, I expect that the VAT return will now have to be expanded. And you can't just expand the VAT return for oil marketers only. VAT is being used by anybody who is VAT registered. Yes. So it will be a standard form that will need to be completed. Now, like you're saying, it's got 3 rates. 3 rates in about 3 days. And you people have to make supplies. And don't forget that for these oil marketers, it is white fuel, petrol, diesel, yes, and kerosene that is being impacted.
But they also have non-petroleum.
Exactly. You've got lubricants, which are still subject to 16% VAT.
Yes.
So I actually expect that it's going to be a very complex exercise. I think for most of these oil marketers, the minute they close the month on Thursday, 30th of April, they will need to start compiling that return, because it's going to be a complex one. I think what's going to be even more complex is the reviews. Remember, Revenue Authority does audits 2 to 3 years down the line.
Yes.
So we'll probably have forgotten the chaos.
The cleanup that was meant to be done.
Exactly. So I think it's going to be a bit of a challenge. And of course, there are those who have argued that prior to the Finance Act coming into force, was the 8% legally there or not? There's a day or so that
yes,
there's a question around that. So we certainly need, we've seen some guidance from Revenue Authority, complex, I have to say, very, very complex. But the proof of the pudding is in the eating, and we wait to see how that return is going to be filed.
And considering VAT is like the second largest tax head, I'm just wondering, in your own assessment, and as at the close of March, data from the Revenue Authority indicates the collection was 84 billion shillings behind target. How do you see this impacting the outturn going forward?
No, absolutely. We expect that because as a consumption tax, it's got an outsized contribution to the taxman's revenue. So we expect that in the next 3 months, because remember the VAT Amendment Act is in place for about 3 months, but then can be extended for an additional 3 months, depending on the situation in terms of fuel supply. So I actually see Revenue Authority struggling with their revenue targets, especially from a VAT perspective, and not just VAT. You probably have the knock-on effect on consumption, because we've seen an impact in terms of consumption. So I think revenue is definitely going to struggle in the last quarter, particularly considering that they are gunning for 900 billion. Yes. That's a tall order.
But we had a surprise bumper collection in March, because typically we have April as a bumper collection month. So March yielded some very good outturn, 200 billion shillings plus. I tried to make sense of what could have happened in March, and also expecting another bumper in April. What did you make of those numbers?
I actually, April is going to be an interesting one, because for banks, remember, banks have done very well.
Yes.
So we all expected that they are going to pay their balance of tax in April, and therefore April is going to be the bumper month.
Yes.
But now March I think is on record as being one of the highest ever collected. So I don't know what really was driving that. But probably we had some people who are who paid taxes in advance, especially given the filing season that we are in. People are trying to
ensure your books are in order early enough.
Exactly, and the filing this year is a bit chaotic, given the expensive validation. But I think that's one of the reasons why we've seen a bump in that outturn.
But talking about this filing season, Robert, we have seen the Revenue Authority go back to the drawing board and say, guys, we have heard you. We want to relax a couple of things in income and expenses validation. You now can upload non-ETIMS backed invoices. Step in the right direction. How is it panning out in the early days here?
Definitely a step in the right direction. And one of the reasons why I say that is because, remember, the notice to taxpayers came in
November last year.
Yes. Which means that for a normal person, you probably did not have all your expenses as ETIMS backed. And so the fact that Revenue Authority has agreed to this concession, I think, is a really good concession, and it will encourage people in terms of their filings. As to how it's panning out, it's a bit of a challenge for most people.
First of all, there's a 10 MB limit.
No, that has now been resolved.
Okay.
When it was rolled out, it was 10 megabytes in terms of the documents that you can upload, which was a big problem, because for ordinary people, 10 megabytes is not a lot of documentation, especially.
It's very small.
It's very small, yeah. So now that's been resolved, and the system is now accepting bigger sizes of documents. But the issue is going to be validation of these expenses. That is really good.
How is the validation being done?
Are
they asking for contracts?
So they're asking for invoices, and then they go to, so for example, your supplier. They'll say, we can see Julian's has claimed an expense from you. So we expect...
Show us your revenue.
Yes, we expect that you will have this revenue. And to the extent that they don't see that revenue, then they'll come back to you and say, Julian's, you told us that you incurred this expense, but we can't see this revenue in Robert's books. So that's how it's meant to be.
That's a fair thing to do, Robert.
No, especially if you're asking for tax-based expansion, absolutely.
Yes.
I think nobody's quarreling with the idea. The quarrel here is how it's been implemented, really. And again, if you look at some of these countries, there's a very good reason why they are facing these ETIMS issues, because it's really a challenge. I think 2026 filing will definitely be one to watch out for. That's the filing that we're going to do in June 2027, because now almost everybody understands that you need your ETIMS invoices. Chances are that KRA will just work with what is on the system, and you've already seen what Shuru is doing, telling you how much she thinks you owe.
Yes, from withholding tax.
From withholding tax.
And Robert, on that point of withholding tax and certificates, we have covered this thing extensively on this platform, but every time I just take a moment to go back to it, because Kenyans keep asking me about this. At what point is withholding tax final, and what are the various rates we're dealing with here? Many of us are just familiar with the 5%.
Okay, so 5% is the common one for consultants. Generally, consultancy will be 5%, but that's not final tax. You're then required to declare your income, which is what Shuru is doing, saying this is the income that we have seen, and these are your expenses, and then therefore this is your balance of tax. That's how it's supposed to work for consultancies. Final tax will generally be interest for individuals at 15% when the bank pays you an interest, When SACCOs pay you a dividend, again, that will be final tax. And when you earn a dividend from a company as an individual, again, that's final tax. So once they deduct the 5% and they remit it to the Revenue Authority, you have no business disclosing that income, and it's not subject to further tax. Yeah. However, consulting income or management and professional fees, what doctors and lawyers and accountants earn, that will be subject to additional tax. Yes. And that's the reason why you now
hence I need my expenses.
Correct.
I see. Which must be ITIMS backed.
Which must be ITIMS backed, and they must be visible. And that's the reason why you need to, whenever you are incurring expenses, when you go for your meetings, please ask for your ITIMS receipts.
But we've also learned, Robert, that it's not enough to demand an ITIMS invoice. The question of transmission, again, is another subject here.
Absolutely.
Yes.
Which is the reason why every time you incur these expenses, periodically go to your ledger and see whether they have been posted. Because I might give you an invoice, and genuinely there was an internet outage, and so I did not transmit. So as far as the Revenue Authority is concerned, you did not incur that expense. And in fact, it's even worse for VAT people, because remember, if it transmits the following month, then you have a reconciliation issue.
Yes.
Yes.
Wow. That exercise will not be an interesting one. But Robert, now, another thing we have seen around VAT is that there is integration between ICMS on the customs side and VAT for auto population. Help us make sense of that.
So the big idea is this. For VAT, you usually get a VAT refund if you are an exporter. That's the one
more often than not.
More often than not, yeah. Of course, you could be having local zero-rated sales, which give you a VAT credit which you can apply for. But more often than not, exporters will be entitled to VAT refunds. For you to prove that you are an exporter, customs needs to confirm that your goods actually left the country, and that's why ICMS is coming in. Yeah. If you remember the Tax Laws Amendment Bill and Act 2024, it brought in a new provision of the Section 12 of the VAT Act, which said that for you to say you've exported, you need a certificate of export, yes. COE. Yeah. And so that's where this provision is coming in now to integrate ICMS customs
with VAT on items.
So that immediately my goods have been processed by customs as having been exported, then it's taken that those are exported goods, and therefore subject to VAT at zero, which then facilitates an easier refund process, because we're not running around after the clearing agents trying to say, oh, give me my exit reports, give me my certificate of exports, and so on. So I think it's actually a step in the right direction. We are waiting to see, because this was just announced recently.
And it's effective May, yeah.
Exactly. So we're waiting to see how it's going to, whether it's going to simplify the process and whether it's going to make VAT refunds a lot easier. Currently, it's quite painful.
I see. But what about those who have argued that the question of VAT refunds in this country is not necessarily a process issue, it's a VAT design question, to the point that you've raised, that it's not only exports which are VAT zero rated, there are local products which are also VAT zero rated, and that complicates the whole process.
Absolutely. I think so it's a design problem, and it's also a funding problem. And we've actually asked, why don't we look at the Public Finance Management Act? Because if you look at countries like Rwanda, Ethiopia, revenue authorities retain a portion of what they collect from VAT to fund refunds. And that's the reason why, countries like Rwanda, you'll get your refund within 30 days after filing the application for refund. So there's definitely an architecture issue there in terms of our law to allow KRA to retain a portion of that. But I also agree with you that we have so many other VAT zero-rated local products, which is fair, because we need to cushion mwananchi from high prices, which then also require VAT refunds. So I agree with your point that the ICMS issue resolves the point around exporters, but local suppliers of VAT zero-rated products will still have an issue.
Still on customs, Robert, what's happening with the duty around vehicles? There is hue and cry out here. There is the conversation around CRSP. Just help us understand what exactly changed.
So, and this matter is sub judice, Julian, so we can't really discuss too much about it. But the issue is this. Revenue Authority is saying we use what they call CRSP, current retail selling price. And so Revenue Authority comes and says, for this type of vehicle, this is the current retail selling price. And so when you import, we're going to be discounting the value for duty purposes in using a given formula. Now, the issue that we have is KRA has revised these CRSPs, and there's an argument that there wasn't sufficient public participation. And as a result, these vehicles, the value has gone so high up.
Yes.
And of course, now the duties and the VAT on that also follows. You know, it's quite high. And I think the Association of Second-Hand Auto Dealers has gone to court and said, we disagree with this. And as it is right now, that the new rates have been suspended. So this is the reason why you're hearing quite a bit of noise. Again, to your point around, you know, how does this impact revenue collections to June?
I've got many questions there, but since the matter is in court, let's close it at that point. Pay as you earn. We were made to expect some relief in terms of bans, much needed, quite belated. We haven't seen them. We're told the finance bill will bring them forth. 30,000 shillings, and then and that was pretty much it. I never had a mention of the two top rates, 32.5 and 35%. How does ISPAC assess this?
So we think that the 32.5 and the 35% should really be brought down back to 30%, because it's very weird for you to have a corporate tax rate of 30%, which under the medium-term revenue strategy is supposed to go to 28%. It's actually supposed to be 28% this year. And then you've got individuals paying tax at 35%. You then create an arbitrage of 7% where people will then say, you know, can I arrange my affairs in such a manner that I pay less tax? Yeah. Mind you, if I'm an employee, I'm also paying these other levies, you know, the affordable housing and so on. Whereas if I arrange my affairs through a company, I probably will get away from that. So our view as practitioners is that there's a need for this rate to come down. It needs to be rationalized. Otherwise, we have a scenario where you know, the top tax rate for individuals is so much higher than the corporate tax rate. It creates room for that arbitrage. But also, how much more are we collecting in terms of that marginal rate? You know, if you look at the Kenya National Bureau of Statistics, the number of people who are in that tax bracket are not that significant. So probably it's better to have people retain a bit more of their money, and then they can spend it, and you can collect VAT and customs and excise duty from consumption.
But the state would argue, Robert, that now you want favorable pay rates coming down, and also the tax-free threshold being bumped up. And here you are also on the VAT side. You've been given a concessionary VAT on key products, petroleum products, which affects everything. Is there a trade-off here between the direct and the indirect tax?
Absolutely. I think there's always a trade-off. And probably one of the things that we need to think about is how much are we encouraging people to also save? Because that's part of the trade-off between taxing people from an employment perspective and then having them consume or invest and generate additional wealth. So I think that's probably part of the issue. But for me, Julian, the bigger issue is this. Can we grow the tax base? We cannot continue relying on the 6 million or so people who are filing returns. Absolutely not. And that's the reason why we need to grow that number of taxpayers, the number of people who are paying taxes, so that then these people who are paying 32.5 and 35% we can bring down their rates to 30%, and hopefully even VAT. You know, under the MTRS, VAT is supposed to be 14% this budget.
But Robert, as you talk about VAT and the changes that we were expecting to see, there has been intimation from reliable sources that the threshold could be going. The 5 million turnover per annum.
Yes.
For those of us who might not be familiar, what would this mean?
So what that means, you know, currently for you to register for VAT and charge, you are required to have sales of up to 5 million shillings, 5 million, actually above 5 million shillings a year. So when you remove the threshold, it means if you're dealing with vatable products, which are very many, by the way, if you're dealing with vatable products, then you must charge VAT. You must then also file. And if you listen to Revenue Authority, their argument is this. We want visibility. We can't have 250,000 people who are registered for VAT in this country. There has to be much more.
Actually, the Revenue Authority argues it should be 800,000.
This is the point. And so they're saying if we remove the threshold, then we'll have everybody coming in. I don't think really that's a solution, because it's also very administratively involving in terms of those filings. Unless you're now then saying we're going to go the route of some of these countries where they say if your VAT turnover is below a certain threshold, then be filing once a quarter. You see, that also becomes a bit of a challenge from a compliance and monitoring perspective. So I also think we need to revisit that conversation, because MTRS talks about taking the threshold to 8 million.
8 million.
Yeah. So why are we talking about eliminating it now?
But maybe there's an argument there, Robert. E-Teams is mandatory for everyone now. And here we have a VAT threshold in place. Is there a case to say that, I mean, if everyone is on board E-Teams and we have this kind of visibility, is there a point now in just saying, look, guys, let's have everyone as being VAT compliant here?
And I think that would make sense. If there's visibility, then absolutely, there's no problem. We can do away with the thresholds. And that issue of E-Teams visibility for us is a very important point, because if then there's visibility, actually government doesn't even need withholding VAT. It doesn't need withholding tax because you can see everything.
You can see everything anyway.
Exactly.
Yes.
So there's a sense in following that E-Teams compliance and ensuring that as many people as possible get on board. But it's not an easy thing.
Robert, I'm seeing we're overshooting our time. Let's dial this down. One is turnover tax. Again, there has been indication that there could be changes coming along those lines. What, in your view, would be top of priority here? If you asked me, the question around that 5 million on VAT versus 1 million on turnover tax, maybe there's need for an alignment there. Is there a point there? I
think there's definitely a point, because even from an administration perspective, you want to deal with one single threshold, so that if you're dealing with a taxpayer who's VAT registered, who is also paying turnover tax, then you're only dealing with one threshold. It's much easier, other than saying I'm dealing with turnover tax of 1 million, but VAT of 5 million. Which probably explains why there's need to harmonize those. But I think also, Julian, the reality of the matter is that we need to revisit this rate of turnover tax, because some businesses are simply not making that much money.
Yeah.
And so when you ask them to pay a 1.5% turnover tax, it becomes quite significant.
But doesn't it play out with the perceived margin of that particular business?
True, but if you think about a hardware which is selling cement, your profit is usually what, 5-10 shillings a bag. So if you take off your expenses for running that, 1.5% still doesn't make sense. So I think there's a need to revisit that rate and probably even the threshold.
And the bands.
Yes, and the threshold.
Okay.
Yeah.
Final question, Bob, is this. There's so much anticipation around Finance Bill 26. In your own thinking, what should be the priority areas that we're looking at now? Because increasingly, if you've seen the last two bills, and actually that is Finance Act 25 and the Tax Amendment Acts of 24, it's leaning more administratively and less on the rates.
And what we expect, Julian, this budget is that that trend will continue. Historically, a budget just before elections, you don't.
It's very conservative.
Yes, exactly. You want to be, and history has shown that it's quite conservative. If you think about Finance Act 2023, absolutely aggressive.
Very aggressive
in terms of new taxes, but suddenly we're expecting that. And if you look at the BPS, the budget policy statement, they have actually indicated the idea is we want to look at administrative measures that will grow the tax base and ensure that everybody is contributing. So I don't expect significant changes. We'd be happy to see the PYE rates coming down or widening of those bands. But aside from that, maybe customs issues from EAC, but not significant changes from a domestic tax perspective.
So nothing earth-shattering?
Nothing earth-shattering.
But if you look at the projections for revenue for the next financial year, you wonder where this revenue, how much can you tweak administration to unlock that kind of revenue?
Well, they said that they have given KRA 19 billion shillings to
supplementary budget one.
Exactly. So now there's a lot of work for KRA there.
Folks, we've been having a conversation with FCPA Robert Waruiru, the managing partner at Ichiban Tax and Business Advisory, as well as the convener and chairperson, ISPAC Public Finance Committee, looking at a number of things. One is the VAT Amendment Act of 26, then the Income Tax Amendment Bill of 26, and then some moonshots into the tax landscape and how Finance Bill 26 is likely to shape up. Remember now, this is the season where we shall be having all matters public finance on this platform, so keep it business redefined.